Are you tired of trying to perfectly time the crypto markets? I mean, who isn't? Well, there's another way to grow your portfolio, one that can literally work while you sleep. We are talking about staking, and it's a really powerful way to earn passive income on the crypto you already own. So let's break down exactly how it works.
Right? This is the core promise, the big idea behind staking, earning more crypto without all the stress and the constant guesswork of trading. It's a fundamental shift in thinking, really, moving from active trading to passive earning. And the cool part is, it's built right into the technology of so many modern blockchains.
Okay, so how is this passive income actually made? Where does it come from? To really get it, we first need to get a super clear handle on what this word staking actually means.
At its heart, staking is all about participating in what's called a proof of stake network. You're not just holding coins in a wallet and hoping the price goes up. No, you're actively locking them up to help secure the entire network. By doing this, you're helping to validate transactions. You're helping to maintain the integrity of the whole blockchain. And for that crucial service, the network rewards you. You know, a really great way to think about this is like a high-yield savings account. You put your money in a bank, they use it, and they pay you interest. Well, staking is basically the decentralized crypto version of that. Instead of your money supporting a bank, your locked funds are supporting an entire blockchain network. And your interest, that comes in the form of staking rewards.
Okay, so we're locking up coins to support a network. Got it. But what's actually happening behind the scenes? What's the magic? Let's pull back the curtain and look at the actual mechanics of how your coins generate those rewards. For you, the user, the process is actually pretty straightforward. First, you delegate your coins to something called a validator. Just think of them as the network's super trusted bookkeepers. They're the ones doing all the heavy lifting, the technical work of confirming transactions, and when they do their job right, the network itself creates new coins as a reward. And you, as someone who delegated to them, you get a piece of that reward, minus a small fee. And that brings us to the two key roles in this whole ecosystem. You've got validators. These are the tech pros, the people running dedicated hardware 24/7. But for most of us, for you and me, our role is a delegator. We just have to choose a reliable validator, stake our coins with them through a pool, and then we get to collect our share of the rewards. The best part? No technical setup required on our end. So, the big question, how much can you actually earn? Well, it's not a fixed rate like a savings account. Your rewards are dynamic. They're always changing. It depends on a bunch of factors. For example, the more people who are staking on the network, the more those rewards get spread out and diluted. But on the flip side, higher transaction volume can mean more fees are collected, and those often get distributed as rewards. It's this constantly shifting balance based on the network's overall health and activity. And hey, we're not talking about some niche activity for tiny projects here. Many of the biggest names in crypto, Ethereum, Cardano, Solana, they're all built on proof of stake. This means there's a huge variety of assets you can stake, and each one has its own community, its own reward structure, and of course, its own level of risk. All right, so when you start looking around at different staking opportunities, you're going to get hit with all these advertised reward rates. But to make a really smart decision, you have to understand exactly what those numbers, like APR and APY, really mean, and what hidden costs might be hiding just behind them. You know, this difference is absolutely crucial. APR, or annual percentage rate, that's just the simple annual interest. But APY, annual percentage yield, that's where the real magic happens. That's compounding. APY assumes you're restaking your rewards, letting your earnings generate their own earnings. APY gives you a much, much better picture of your long-term growth potential. So you always got to check which metric they're showing you. And of course, those big advertised rates, well, that's not your final take-home pay. Not even close. Validators and staking pools, they take a commission for their services, and there can be little network fees here and there. The number that truly matters is your reward after all of these costs have been taken out. So we've covered the exciting part, the potential rewards, but now we have to talk about the other side of that coin, the risks. And this is something you absolutely 100% must understand before you even think about committing any of your money. Let me just say that again, because it's the most important message here. Staking is not risk-free. Earning rewards, in crypto and in life, always involves some kind of trade-off. And it is so important to understand what you're putting on the line. One of the single biggest risks is something called the lockup period. A lot of networks require you to lock your coins for a set amount of time. And that means if the market price suddenly tanks, you can't sell. You can't do anything. Your funds are totally illiquid. You just have to sit there and watch it happen, which, as you can imagine, can be incredibly stressful and very, very costly. So, beyond just being locked in, there are other major risks to think about. Price volatility is the obvious one, right? A 5% staking reward doesn't mean much if your asset's value drops 50%. Then there's this scary one called slashing. It's a penalty where you can actually lose a chunk of your staked coins if your validator messes up or acts maliciously. And, of course, always, always be skeptical of projects promising unbelievably high returns. If it looks too good to be true, it almost certainly is a scam. So, after weighing all of this, the exciting potential against some pretty serious risks, we get to the final and most important question. Should you do it? And this right here is the key takeaway. Staking can be a fantastic tool for generating returns. It really can. But it is not a passive set it and forget it kind of investment. It demands that you do your homework, that you understand the specific rules and lockup periods for whatever asset you choose, and that you go in with your eyes wide open to the risks. Ultimately, the decision really just comes down to you, to your personal financial goals and your comfort level with the risks we've talked about. The right answer is going to be different for every single person. So we hope this breakdown gives you the framework you need to start thinking about it and make an informed choice for yourself. Thanks for joining us.